During July and August, financial markets enter a distinct operational regime known as the summer doldrums. Institutional trading desks run light, and daily volume drops significantly. As heavy institutional liquidity drains from the system, retail operators make a fatal error. They step into this thin environment, attempting an aggressive trend continuation posture. When these traders spot a minor local breakout, they misidentify it as an aggressive impulse A wave. They assume they are catching the ignition of a sustained trend, and they immediately begin chasing the price. What they are actually seeing is a mechanical trap. In a low-liquidity summer environment, breakouts are intentionally engineered to fail. Market maker algorithms slowly drift price outside local ranges. There is no genuine market momentum driving this move. The summer algorithms are simply probing these outer edges to hunt stop losses and sweep naive liquidity sitting on the order book. Applying high-torque momentum strategies in this environment guarantees mathematical account degradation. Attempting to trade a runaway trend when the market lacks underlying volume ensures the resulting chop will tear a portfolio apart. Surviving this seasonal shift requires completely inverting your operational playbook. You stop looking for trend ignition and start executing pure mean reversion. This framework relies on the order book physics of what we call a thermodynamic vacuum. When volume dries up, price enters this vacuum state. As the market slowly drifts higher, there is zero heavy institutional capital actually supporting the move. A healthy, volume-backed rally builds a solid structural staircase of bids to support the price. A summer drift leaves the floor completely empty beneath it. Because these summer breakouts operate inside an empty order book, they are inherently unstable. The moment they hit structural resistance, they become highly susceptible to violent, algorithmically driven reversals. Navigating this state zero summer regime requires replacing subjective chart reading with a rigid mathematical architecture. This diagram outlines the first component of the model, identifying the precise boundaries of the day's variance. Here are the initial standard guardrails, mapped as the upper DRW H1 and lower L1 gates. These gates function as mathematical walls. During light summer trading, the active session's entire price drift is frequently contained within these exact levels. Watch how the price action runs out of breath the moment it collides with the H1 boundary. For trading days generating slightly higher torque, we map a secondary set of failsafes. Plotted even wider are the extreme boundaries, the DRW H2 and L2 lines. If the initial gates break, market maker algorithms intentionally drag price out to these extreme parameters. The goal is to force the absolute final drops of momentum out of the retail market. Mapping these precise H1, L1, H2, and L2 gates removes guesswork from your execution. You are looking at the hard algorithmic coordinates where false momentum is mathematically programmed to die. We define the market's interaction with these boundaries as the deep B-wave rubber band effect. Taking a closer look at this chart, you can see how tension behaves inside a vacuum. The further the summer algorithms drag price away from the day's true center value, the tighter the rubber band stretches. These vector arrows reveal the immense downward pressure building against the outer H2 extreme boundary. Operators cannot preemptively step in front of this move. You must wait for a precise visual confirmation that the tension has reached its maximum breaking point. Watch the exact moment the line tries to push past the barrier, fails instantly, and leaves behind a sharp micro-rejection wick. This specific geometric footprint is your mandatory signal that retail buying power has completely evaporated. At this exact microstructural second, the order book experiences a sudden liquidity void. There is absolutely no one left to buy the top. Market makers immediately execute a rug pull. They withdraw their supporting bids, and without that artificial floor, the rubber band snaps backward with violent velocity. Exercising patience for that single micro-rejection wick separates a professional operator from an amateur. It confirms the exact millisecond the institutional trap has been sprung and the reversion has begun. Once the rubber band snaps, the trajectory is locked in. This violent reversal does not stall out at random intervals. The algorithms driving the move actively hunt for predefined structural value enters. They need to drive price back to the mean to rebalance their inventory before the next session begins. This chart highlights the first major take-profit zone in the sequence. As the data line plummets away from the extreme high, it directly targets the DRW center pivot to lock in baseline profits. The center pivot serves as the active session's opening benchmark. It is the initial center of gravity that the market drifted away from at the start of the day, but the sequence frequently pushes further. Below the center pivot sits a deeper macroeconomic mean. Watch as the descending line cross-rotates through the center and magnetizes perfectly to the hourly 55 core. The hourly 55 moving average acts as the ultimate institutional balancing plate. This is the structural basement where the market's internal ledger is finally leveled out. Defining these exact targets ensures you extract asymmetric value from the sequence. You ride the algorithmic current to its logical conclusion instead of exiting the trade prematurely. Identifying the setup is only the first step. Executing this framework safely requires strict operational discipline. The summer doldrums classify as a state zero market regime. That classification mandates an immediate adjustment to your payload sizing. The core rule of summer posturing is non-negotiable. You must reduce your standard contract size by exactly 50%. Thin volume breeds erratic tech noise. The market will violently whip back and forth within micro ranges, easily triggering premature stop-outs on fully loaded positions. Having your payload provides the trade the geometric space it needs to breathe. It is a mathematical necessity to survive the expanded volatility noise native to summer algorithms. This chart highlights the absolute final guardrail for your counter-trend entry. Just outside the main boundary sits a shaded buffer area, capped by a hard red horizontal line. This shaded buffer is the true CF fading zone, your mathematical line in the sand. Place your stop loss exactly one tick past this edge. If price crosses this invalidation limit, the system immediately shuts down all activity. The logic here is strictly quantitative. If a 5-minute candle closes cleanly outside the fading zone, the mean reversion setup is mathematically dead. The regime has shifted from summer chop into an authentic runaway trend. When that invalidation triggers, you must follow the machine's lead. You take the paper cut and shut down the play. No bruised ego and zero averaging down into a losing position. By combining precise variance walls, calculated payload reduction, and an uncompromising one-tick invalidation limit, the deep B-wave protocol performs exactly as intended. It converts the chaotic, erratic noise of the summer doldrums into a highly systematic and reliably extractable edge.